Alibaba's share price for the past year has been in a vertical freefall. It's caused many weak-handed investors to pull out, and those that have held on have had to deal with the ridicule of the naysayers. But to them, I say the following.
I'm not fucking leaving! The show goes on! They're gonna need a fucking wrecking ball to take me out of here! They're gonna need to send in the National Guard or fucking SWAT team, because I ain't going nowhere!
So here we are, guys. Q2 2023 results are out, and it's looking really good. In fact, I'm gonna prove to you guys that the results are much better than you even think. So smash that like button and let's go. What's up, guys, and let's get right into it. But if you're not subscribed, hit that red subscribe button right now, or otherwise I'm going to start shilling meme stocks like AMC, like all those other hacks. So as of the recording of this video, notice, guys, that the stock was up approximately 8%, and in pre-market trading, the stock was actually down. And you guys saw when I released the first look, I was actually very confused as to why the market was selling the security down, because as I digested the results more and more, I was sort of compelled to say that it was an exceptional quarter in terms of guidance, and dare I say, the quarter was better than you think, and that's what I'm going to try to convince you of in this video. But full disclosure, take everything that I say with a grain of salt. I own a position in Alibaba, and so I'm biased as hell. And so this is the main takeaway, and this is what I really want you to pull from the results. This is from their transcript, and this is why I believe that the Alibaba results are much better than you think. Some of you guys have been commenting about this in the comments, and you guys are right. Notice that Taobao deals, Taocaicai, Ali.me, a map, which is in their local consumer services division, Lazada, which is in their international division, and Youku have significantly reduced their losses. And so in other words, as this new CFO has taken over, he's really focused on running a leaner and more profitable organization, and he says as much in the Alibaba transcript that was released today. And this is what their CEO has said. We have taken note of the latest adjustments in China's COVID-related policies and proactive commentary from relevant government regulators about promoting the digital economy and high-quality development of platform businesses. None of that is new. I've talked about all of that with you guys on this channel before. But this is the most important part. We believe that COVID will ultimately pass in our society, our economy, and our lives will eventually return to normal. And so effectively what he's telling you is that he believes that they're going to move beyond this. And now effectively what's happening is their CEO largely agrees with me. Now, he probably does have to say that, but it's nice to hear it from people who are on the ground in China. And of course, you know, the CEO is close to the CCP, and so he probably knows that they're moving in the direction that they're saying that they're moving in, which is loosening the COVID policies. And when I hear stuff like that, and I hear the CFO talking about how they're going to run a more profitable organization, and then I have to run those through my model and get a higher valuation, it makes me want to buy more shares. And this is what I mean about what the CFO said. A lot of people, including the media, have missed this point. So this is what he said. Since I've taken up the CFO role earlier this year, we have largely been considering three important factors. The first one is to improve our medium to long-term revenue growth and this is the most important part, profitability profile. Second, they want to be more selective when it comes to M&A activities. And here's the more important part, they want to monetize less strategic investments and unlock the value of selected subsidiaries. And so effectively what they're telling you there is that they're going to be selling some of the investments that they hold on their balance sheet, and they're going to probably use that capital to buy back shares. That's what I'm thinking, because look what they do in the next paragraph. They're essentially going in line with that form of thinking. We have deployed approximately 70% of free cash flow to share buybacks this year. And so in other words, I've written my summary to the right here in the box. They are trimming the fat and expected to see higher profitability as time goes on. And with the sale of non-strategic businesses, I think they are setting themselves up for even larger share buybacks. This is another reason why I'm strongly considering buying more shares. And the way that I'm thinking about buying them is by using a vertical call. So it's more of like an option strategy, because I already have cash secured puts on the name. I already own the shares as well. And I have have some excess capital sitting aside. In fact, I have a lot of excess cash sitting aside. And so if I can get the right limit price for the spread in, I'm going to absolutely execute a vertical call on Alibaba. Now, I don't recommend that you guys follow anything that I do. I'm just letting you guys know what I'm thinking about as time goes on. Now, let's go right into these results. The first thing that I want to point out is that customer management, that's Taobao and Tmall, it's down 7% on the quarter, and year to date, it's down 8%. And last quarter, it was down 10%. So it's down less, but the top line revenue is still down. But they provide us with some information on how they're going to deal with the revenue declining in this segment. So I really like that. Now, the other thing is local consumer services year to date is up 13%. And this is impressive as hell because you recall the CCP was asking the delivery companies to reduce fees. So the fact that local consumer services is still up is absolutely incredible. And it means that I'm going to have to take up my revenue growth expectations for LCS. And the other thing is Cainiao. Notice how much their revenue is up. It's up 20% and 36% in the quarter. Now, anybody who is paying close attention knows why Cainiao is up. All you got to do is look at the number and you know that Cainiao is absolutely supporting the growth of Taobao, which is a competitor to Pinduoduo, and Taobao is doing very well. And so all of those posts that have been set up for Cainiao to support the Taobao business are absolutely becoming more and more profitable in this environment. And we're going to see this continue. But what it really forces me to do is take up my revenue growth estimates for the Cainiao logistics segment. Now let's go right into China commerce. This is the main business segment for the company. It's the bread and butter, and it's where essentially all of the adjusted EBITDA is coming from, or free cash flow. So you can see on the right that customer management is down 8%. And then, of course, the adjusted EBITDA is actually a positive 6%, but down 5% year to date. And so what's happening? Well, let's start with the revenue decline being down 7% on the quarter for customer management and 8% year to date. They're telling you that the reason why the customer management sub-segment revenue declined by 7% is mainly as a result of softer consumption demand, COVID-19 resurgence and restrictions, as well as ongoing competition. And so effectively the quarter was impacted by COVID-19. We already knew that the lockdowns were going to affect the quarter, so that's not a surprise. However, and this is the important point, and I highlighted in red here, is that the decline narrowed compared to the prior June quarter as key categories such as apparel and accessories and consumer electronics saw a less year-over-year decline. But we are now starting to see COVID impacts subside, and so I expect this quarter to not decline at a high rate as 7% year over year next quarter. And overall, I was forecasting an overall decline for this segment of a negative 7.5 year over year, but you can tell that, 6 months in, the segment as a whole has only declined by 1% on the top line. So what this means is that I'm going to have to take up my revenue growth estimates. That's effectively what's happening here. And when it comes to the adjusted EBITDA, notice that they hit 6% adjusted EBITDA in the quarter, and overall they're only down 5% on adjusted EBITDA year to date. So what's happening there? Well, they're telling you right here that their businesses that they've been investing in significantly, and the businesses that they said that they're going to focus on in the investor day, they're actually starting to make progress on. So they said that the increase in the adjusted EBITDA was primarily due to Taobao deals and Taobao's reduced losses as a result of improved operating efficiency. And they said that Taobao significantly narrowed losses year over year, driven by an optimized pricing strategy, enhanced sourcing capability, and lowered operation and fulfillment costs. So for those of you who think that Alibaba is just rolling over for Pinduoduo, I would say think again. In fact, I would say watch out, Pinduoduo. Alibaba is on your heels, and they're very much a success. Now, remember I just said that they had some plans for Taobao and Tmall to address the revenue declines? Well, they talked about it in the investor presentation or conference call that they held today after the results came out, and this is what they said. After many years of operation, Taobao and Tmall is now deeply entrenched in our users' mind as the shopping destination. Taobao and Tmall remain around 124 million with a retention rate of 98%, and the 88 VIP membership, which is like their Amazon Prime, held steady at 25 million this quarter. And so what they're telling you is with that 98% retention rate, people are still using the platform, and that's a good starting point. Now, one of the things that a lot of people were mentioning previously is that they haven't been talking about their Singles Day. Well, they talked about it right here. And so I'm not sure why news outlets are still, even after the conference call has ended, reporting that Alibaba hasn't spoken about it. It's right here. During their recent 11/11 Global Shopping Festival, Taobao and Tmall's total GMV was in line with the performance last year during the same period. So it wasn't a huge decline, which is what a lot of us expected, and that's better results than what I would have expected this year. But they mentioned a few factors that negatively impact their 11/11 celebration. The first one was the average temperature across China was much warmer than usual, and so that caused a weakening in the consumption appetite for apparel. The second item that impacted their celebration was that nearly 15% of the delivery areas were impacted by COVID lockdowns across China as they experienced abnormal or suspended logistics services. So the fact that sales stayed in line despite that was incredible. Now, I did allude to the items that they're going to be focusing on to get Taobao and Tmall back on track. That's right here. So with Taobao and Tmall, they continue to identify opportunities to better serve customers of different demographics and have achieved high customer retention of that 98%, which is what I just described to you or just showed you. And so these are the three areas that they expect to address to plan to sort of go after that weakness. And so ultimately what they're going to be doing is upgrading the shopping experience for their customers. And so the way they're going to do that is, one, by engaging in content. And so essentially they're going to enhance the content and recommendations displayed on the homepage of the Taobao app. So what I think there is that they're going to be utilizing AI technology similar to what Meta is doing on their legacy Facebook app to get people to use Facebook and Instagram more, and it's been working. The second item that they're going to be focusing on is logistics, which is where Cainiao comes in. Doorstep parcel deliveries of Taobao and Tmall orders increased significantly year over year, and doorstep delivery service for Taobao and Tmall orders was offered in more than 300 urban cities throughout China. So watch that success continue. And finally, they're investing in their customer service, and so they've continued to invest in human customer service capacity, which result in improving post-purchase net promoter score. And so effectively, they're going to continue to hire, and that bodes really well to the CCP's intentions of ensuring a commonly prosperous Chinese community or country. And so you hire more people, you're looked favorably upon by the CCP, and that's exactly what Alibaba is committing to here. Now let's go into their international commerce segment, and this segment was very unexpected. So notice that their revenue is up 3% year over year, and that's okay. In fact, I kind of would have expected revenue to sort of be flat year over year, but notice on the 6 months that international commerce is okay, but it's that international commerce wholesale, which is up 9%, which is keeping the boat afloat. But notice that adjusted EBITDA line. In the previous quarter, adjusted EBITDA increased by 61%, so a much lower loss. And year to date, it increased by 30% or 28%. So that's very unexpected. But another thing that's really unexpected about this segment is that Cainiao, which is in Turkey, Turkey is experiencing significant amounts of inflation. So you'd think that the sales in the country would be much lower, but in fact, part of the increase in their revenue is primarily due to the increase in revenue contributed by Cainiao as a result of strong order growth from its e-commerce business and more efficient use of subsidies. And it's that subsidies part that I got to learn a little bit more, and so I'll do that as time goes on. But the area that I really want to focus on is that adjusted EBITDA improving. And so what they're saying is that the decrease in loss year over year was primarily due to the reduced losses from Lazada and Cainiao. Continued narrowing of losses from Lazada was a result of continued improvement in monetization rate by offering more value-added services as well as enhancing operating efficiency. And so I just wrote my comment here as soon as I read it, and I said, wow, this is huge. I need to update my modeling to forecast profitability in this segment. That's insane, because remember, guys, when we talked about this segment in the Investor Day, what we determined is that they were getting beat up by C Limited. So the fact that they're increasing profitability while keeping revenue steady, so in fact revenues are not declining, it bodes very well. And so as I think about this segment into the future, I could very much start predicting profitability within at least 5 years from now, which is a lot different than what I was previously doing, because I was sort of permanently forecasting out negative revenue or negative adjusted EBITDA for this segment. So it was a positive revenue growth, but in line with that positive revenue growth was a consistent negative adjusted EBITDA. If I start taking that up, of course, you're going to see more contribution to the bottom line, and thus the valuation will just go up. Now, just to put everything into perspective, in Southeast Asia, order volume did decline 6% year over year as COVID-related restrictions were lifted and offline shopping resumed. So there was sort of like a return to normalcy there. However, Trendyol's order volume grew over 65% year over year on the strength of its e-commerce business and a fast-growing local consumer service. And so that's what's happening there. It's the fact that delivery is just getting better in Turkey, so more and more people are adopting online consumption. All right, let's get into local consumer services. And the point that I really want to make here is that I was very impressed that in the quarter, revenue was up 21%. And the reason why I was impressed here was because the CCP had previously asked them to bring down their delivery fees to spur more employment during lockdowns. And I did make videos on this. And so if you guys go back through the library, you can see me talking about this. And I was actually really upset about it, to the point where a lot of you guys were saying, why am I so down on Alibaba? Well, I was down on them, or at least I was down on the CCP, because sometimes when you have these businesses that are running losses, you don't want to push them into further losses to the point where they just shut down the business. And so I was hoping that didn't happen, and of course it didn't happen. They managed to grow revenues and reduce their EBITDA margin. So you can see that revenues grew 21%, but the EBITDA margin also, the loss also declined. And so why did revenues grow? So they're saying that revenue grew primarily due to revenue growth resulted from strong growth of AMAP orders, as well as higher average order value and more efficient use of subsidies that were contra revenue of Ellie.me. So I just got to figure that part out, and I'll probably do another video on it discussing all of that in detail. Now, when it comes to their adjusted EBITDA getting better, this is going to cause me to forecast lower losses for local consumer services, because year to date they're running at 30% or 28%, which is really good. They're saying that the adjusted EBITDA got better primarily due to the continued narrowing of losses from our 2 home and 2 destination businesses. So that's effectively all of their businesses. So not really a good explanation there, but what they're saying is narrowing of loss from our 2 home businesses was driven by Ellie.me's improved unit economics per order. So that's really good, which was due to increased average order value year over year, reduced delivery cost per order, and optimized user acquisition spending. So here's the interesting part. The CCP caused them to reduce their revenue amounts, the rates that they would charge. And what ended up happening is it didn't actually increase their delivery cost per order. So that's very interesting. And so I need to review the profitability for this segment now that profitability and scale is improving. And so this is going to increase my valuation for the company as a whole, because you know what, year to date they're doing very well. So you can see that they're delivering on what they said they were going to deliver on their Alibaba Investor Day. So I'm very impressed with local consumer services, but now let's move into Cainiao. Notice that Cainiao actually hit profitability in the quarter. They had a slight adjusted EBITDA margin. Now, I think that this segment is going to be probably largely run at sort of like a break even, because the profit will go to the other segments that they support. But hey, if I can just forecast it out at a 0 adjusted EBITDA profit margin, that once again is going to take up my valuation. And so why did revenue increase 36% for the quarter and 19% year over year? Well, they're saying that revenue increased primarily by the increase in revenue from domestic consumer logistics services as a result of service model upgrades since late 2021, where Cainiao takes on more responsibilities throughout the logistics process to better serve customers and enhance customer experience. And as expected, this will prove too much for Pinduoduo. This is one of the major backbones for Taobao, as discussed in Alibaba's 2021 Investor Day. And if you missed that video, go back into my library from December of last year, and I have a 10-part series on it. Now, when it comes to adjusted EBITDA, I wish they gave us a little bit more disclosure as to why they're running at a 0% margin or slight profit. So I really hope that they can give us something about this and give me something on forecasting profitability going forward. But until they do that, I'm going to forecast no profitability going forward, but higher revenues nonetheless. And in their conference call, they gave us a little bit more information on why Cainiao is more profitable. They're saying, notice that the Cainiao Post network, this is that network that they wanted to grow out to help help Taobao and other elements of their business as well, like Taobao deals and such as well, but really for Taobao. And so the Cainiao Post network grew by 20% year over year and now has more than 170,000 locations. It has comprehensive coverage in residential communities, school campuses, and the rural villages across China. And that last part, the rural villages across China, is what you need to compete against Pinduoduo, and they're doing it very well. And so the Cainiao Post has become an important touch point for serving customers. And so to this, I say, good luck competing with this Pinduoduo. Alibaba's got your number. Now let's move on to the cloud segment. So as you can see, revenue for the cloud segment, or at least revenue growth, is slowing down to 4% for the quarter and 7% year over year. And the EBITDA margin is maintaining at 2%. Now, the first thing, I do want to give them some credit. Maintaining profitable is a big deal in this environment because their competitors' cloud business profitability is declining. So Amazon, I suspect Alphabet's and Microsoft profitability is declining as well, but I just can't tell you off the top of my head. So note, however, that their competitors are more established and profitable than Baba Cloud at the moment, but the fact that Baba Cloud is maintaining its profitability in an environment where rates are being cut is a good news story, and so I don't want to take that away from them. However, the area that I'm a little bit concerned about is the fact that revenue growth is slowing, and so they're saying that the revenue growth is slowing because of a decline in revenue from customers in the internet industry, mainly driven by declining revenue from the top internet customer that has gradually stopped using their services, their overseas cloud services, for its international business due to non-product related requirements. And I believe that that is TikTok. Additionally, online education customers, as well as softening demand from other customers in China's internet industry, are causing revenue growth to decline. And so the slowdown suspicions are coming true. I am one of the only YouTubers to bring down expectations for Alibaba Cloud prior to the release of this quarter and highlighting the big risks. And so I will pat myself on the back there. And a lot of you guys did write in my comments that you don't believe to be that pessimistic on Alibaba Cloud, but we're seeing it now. So it's not like I was making this stuff out of thin air. And so even my growth expectation of 10% year over year for cloud this year might have to come down. And so what I want from Alibaba here is for them to do some damage control and let us know how they're going to grow out the cloud segment. And they give us a little bit on that. So they're saying that Alibaba's revenue growth structure is now healthier and more sustainable, and they're focusing on pursuing high quality growth. And so just looking at their revenue by industry, the non-internet industry revenue grew at 28% year over year, and its contribution to total revenue increased from 53% to 58% quarter over quarter. So if the fastest growing sectors, which include financial services, automotive, telecom, and public services, continue to increase at this fast rate, I do expect the cloud services revenue to continue to increase. And so based on this explanation, I'm not going to reduce my cloud forecast. I think 10% year over year is good for this year, and then 15% thereafter. You guys let me know if you guys are thinking about forecasting this at higher than 15%. If you were to say that it's going to grow in line closer to that like 37%, which is what they expect the Chinese cloud segment or industry to grow as a whole, I wouldn't even say that you're wrong. I'm just being conservative here, and I'm forecasting at 15%, and I'm forecasting marginal profitability. I think I'm just increasing it by 1% a year into the next 10 years. And here's where they tell you how they're looking to build out a moat for the Alibaba Cloud business. This is some new information to me. And so these are highlights of their proprietary technologies discussed during their annual Aspera conference in November of this year. And so what they're saying is that they're focusing on three areas, or at least they wanted to highlight three areas. The first is the CIPU system that is integrated with their Aspera operating system. And so what's happening here is this new CIPU system is creating more advanced processing or faster processing by more than 20% of an improvement over the industry average. And, you know, I'm not super knowledgeable about the CPU business in general, or the CIPU business, computing in general. I've just started to learn about it. So guys, let me know how impressive this actually is. Now, going serverless is something that I do understand because I tend to be a customer of that. Alibaba is making its key cloud product serverless to enable customers to concentrate on product development and deployment without worrying about managing servers and infrastructure. And that, of course, means it's less cost. So you can see why that's very important for corporations. Currently, Alibaba Cloud has more than 20 serverless products and continues to enable more product categories to become serverless. So I think if their performance is 20% better than industry average and they have more serverless products than anyone else, those are two major moats that they continue to build upon. And so I really like that. Guys, let me know what you guys are thinking as you see this. And then the final thing, and of course this just builds on top of itself, is that Alibaba unveiled Model Scope, which is an open source community dedicated for global researchers and developers to develop and share AI modules in an easy and cost-effective way that can be deployed on Alibaba Cloud and other cloud platforms. So this I don't understand too much, but I think what it means is that they're just going to develop AI processes that allow entrepreneurs to use their ecosystem to drive their businesses forward. And of course, Alibaba is a beneficiary of that because their ecosystem is the one that's being built upon. Now let's dive right into their free cash flow calculation. So remember, guys, I did tell you that I was going to look into that loss on deemed disposals or revaluation of investments and others, that amount of 36 million RMB, well, or $5 billion US. So although it is an add back for free cash flow, this is partially a non-cash item. And the reason why is they describe it as net losses arising from the decrease in market prices of our equity investments in publicly traded companies and a decrease in share of results of equity method investees. So the reason why this is not exactly a non-cash item, even though it's treated as a non-cash item in their free cash flow calculation, is because they initially made an investment. And so that write down, which went through the P&L, is effectively telling you that they lost money. So they ultimately did lose $5 billion just in this particular period. It's an add back. So just keep that in mind. And so the first question I would have is, are they continuing to invest in equity method investees? Are they continuing to invest in publicly traded companies? And I just showed you that the CFO already said they're not doing that anymore. In fact, they're looking to sell more. So you might see more write-downs as time goes on, especially in this environment, but they're monetizing what's being presented at fair market value on the balance sheet anyways. And they're going to be using that, I would think, to buy back shares. And so their balance sheet is going to be reflected on our valuation at fair market value. And so this is not a significant issue to worry about at the moment, but just note that you might see further losses as time goes on. They're non-cash losses because they made the investment previously, and it's already been reflected out of the balance sheet. Now, I know that might be complicated, so join us next week, Friday and Saturday, on our monthly calls, and I'll dive more into this and show you exactly how it works through the financial statements. Now, free cash flow year to date is running at approximately 35% higher than prior year. And if they finish the year in line with trend, then we should expect $21 billion in free cash flow, which compared to the market cap means that Baba is trading at approximately 10 times free cash flow, which is absolutely crazy considering their huge growth profiles. So, you know, guys like Michael Burry will tell you that China is cheap. Ray Dalio will tell you that China is cheap. I'm showing you that China is cheap, at least when it comes to Alibaba. So the question is, what are they doing with their free cash flow? Now, some of you astute investors actually noticed this, and you guys were commenting it. So if you guys noticed what I'm going to talk about next, pat yourselves on the back. And in fact, let me know in the comments that you called this out, because I want to pin some of you guys who did call it out. But effectively what's happening is, as of November 16th, they reached approximately 18 billion of shares under their existing 25 billion share repurchase program. And so notice that they called out November 16th. So their period end date is September 30th. So why would they call out November 16th? Because they're telling you that they purchased shares in between September 30th and November 16th. So, and I'll give you those numbers in a second, but because of that, they approved an increase to their existing share repurchase program by another $15 billion and extended the program through the end of March 2025. Remember, guys, in the Alibaba preview, I did say that they're going to increase the share repurchase program authorization within the next 12 months. I didn't realize that they were going to do it in the next 2 days, but hey, pat on my back at least. And this is what I was talking about the astute minds. Notice that for the fiscal first half ended, they purchased approximately $5.6 billion of shares, which is equivalent to about 70% of their free cash flow during the period. But that's not it. Notice that from October 1st to October 16th, they purchased another $2.6 billion in ADSs on their share repurchase program. So October 1st and November 16th were absolutely accretive repurchases. And I would say that the first half of 2022 was also very accretive, especially when you get to the tail of that first half. So they purchased $8.2 billion in shares, but you're only seeing the repurchases of the 5.6 on their financial statements. So expect at least $2.6 billion more of share repurchases when the results come out for the next quarter. And in fact, I could see that very much at 5.6 or greater. So that's very good news. But what about Ant Group? That's on the mind of a lot of people. Well, they did provide disclosure for that. So you can see that Ant Group's profitability actually declined significantly. So you can see that it went down from 6.5 billion RMBs to 2.4 billion RMBs. So they're saying that the share of profit for Ant Group declined due to the net decrease in fair values of investments held by Ant Group and a decrease in Ant Group's operating profit. So as the CCP continues to slice and dice this company, Alibaba's share of profit will decline. But recall, guys, that I'm not giving them any credit for Ant Group. So this actually might take up my expectations, but I'm not going to move it at all. And notice that they did have write-downs and impairment losses in their other investments. And the reason why this is happening is because they've said that with respect to certain equity method investees, as a result of a severe and prolonged decline in market values of certain equity method investees against their respected carrying value, they had to write the impairments, because these things, some of them are written at fair market value. And then, of course, the equity method investees, you kind of have to impair those if you don't think that the net income or your portion of their net income will come back to levels that you would expect it at. And so once again, I would be concerned here, but their CFO already came out and said, look, they're starting to get rid of these things and they're focusing more on higher profitable operations or core operations. And so I'm happy. That's enough that I need. And I know that as time goes on, more of these are going to be sold off. They're reflected at essentially fair market value right now. And even things like their equity method investees are kind of reflected at fair market value right now, or at least what they think is fair market value. So as time goes on, liquidate these things, buy back shares. That's how I'm forecasting it in the valuation. That's how I have been forecasting it in the valuation for the past year or so. And so do it. Good for us. Now that is the results, but I know you guys like looking at the options chain to see what sort of like the cash secured put opportunities are available. And so that's what I want to cover with you in this next section. And so looking at the January 19, 2024 cash secured puts, I'm going to talk about the $50, the $60, the $70, the $80, and the $100 cash secured puts. Now, this is that cash secured put calculation tool that I give you guys for free. I can't believe YouTubers will charge you guys for these calculators. It's so dumb. I can't imagine charging you guys for this stuff. So that's why I built it for you guys and I just give it away to you for free. And if you're not familiar with how to use it, go look at my video. It's on my main channel of free tools and courses, and find the video that talks about utilizing the cash secured put calculator. And so what I'm doing here is the only thing that I'm changing are the variables of strike price and premium. And so you can see that the $50 strike price for the January 19, 2024 cash secured put has an annual yield of 7.7%. and a net purchase price as a percentage of the valuation of 21.2%. So it's pretty good. Just the annualized yield is not that great. It's kind of low, but I wouldn't mind buying the stock for a net purchase price of $45.50. So, I mean, it's not a bad investment, especially if you just want to put it in the income portfolio that you have. Now, looking at the $60 cash secured put, you can see that it's got an annual yield of 10% and a net purchase price of $52.85 for a net purchase price as a percentage of its valuation of 24.6%, or effectively 25%. So once again, not bad. A nice 10% yield, not bad for the income part of your portfolio. I doubt that this thing executes and you have to purchase it, but you know, never say never, right? Now with the $70 cash secured put, you can see that the premium's $10.70. It gives you a pretty decent annualized yield. This one you can't shake a finger at. It's 13% annualized, and the reason why, you know, it's 13% annualized, even though if you just take $10.70 and you divide by $70, you get 15.3, is because there's more than 365 days until strike, and so you have to annualize it, and so you spread that 15.3 or 29 over 428 days, and it gives you 13.04. Now, the net purchase price as a percentage of the valuation is 27.6%. So this is not bad, but it's the next one that I like the most. So the $80 strike price cash secured put has a premium of $15 per share. It gives you a net purchase price of $65. I think that's really low, and so that gives you a net purchase price as a percentage of the valuation of 30%. But notice that the annualized yield is 16%. So now we're above my threshold of 15%. So I really like this one. It has the right balance of yield and downside protection, because you guys know the relationship. As you go higher and higher on the strike price, the net purchase price goes higher and higher. And so your net purchase price as a percentage of the valuation goes higher, and so you have less downside protection. But when you're buying this company at approximately 30% of its intrinsic value and getting a 16% annualized yield, I think that's a really good place to be. Now, I'm a little bit more of a bull on Alibaba, so what I ended up doing is I ended up selling the January 19, 2024 $100 strike price cash secured puts at $30 per share. But as they're trading right now, they're trading at $26.50. So that reflects an annualized yield of 23% or 22.6, and it has a net purchase price as a percentage of its valuation of 34%. This is really great if you wanted a more aggressive yield. And so, you know, the yield is almost 23%. And you still have a lower than current net purchase price of $73.50. And I believe that the current share price is around $85. And so recall, guys, that I sold this option back in April of 2022 at approximately $30 per share in premium. And so it's a little bit lower of a premium right now. However, the annualized yield that I was getting at the time was around 15%. You're getting a higher annualized yield despite getting a lower premium, because there's a lot fewer days until strike. So take that into consideration. Although you're getting a lower premium, you're technically getting a better investment than what I entered into. Now, when it comes to covered calls, I just want to cover one for you guys, which is the $95 covered call. So the current price is $83.27 as of the recording of this video. And so if you buy the shares at $83.27 and you sell the $95 per share covered call, the premium that you generate is $17.25. That's an annualized current yield of 18%. And so if you don't get executed on this, so if the shares don't close at $95 by January 19, 2024, you generated an 18 or 17.7% yield on this. However, if you do get exercised on this, you have generated a 27.6% total annualized yield. And once again, if you don't get exercised on it and the share price goes down, well, your net cost basis is $66.02. And so I think covered calls are a great way to generate income in accounts where you can't sell cash secured puts. If you buy the shares at the market price and sell the $95 covered call, you'll generate an annualized yield of 18%. And a total annualized yield of 28%. I just mentioned that, but I just want to mention it again. But of course, with covered calls, you give up that upside beyond $95, but in return, you have a lower cost basis if you're not exercised at $66 per share. So covered calls may actually be the right decision for many of you. Now, once again, like I always say, never look at any of the options, never look at the valuations, never look at anything that I provide to you on this channel as a recommendation for you to buy. I'm not like these other shill YouTubers that will just throw stocks at you and say, buy. No, this channel is all about doing the research yourself, and I provide my research because I just love this game. Now, speaking about my research, let's go into how I'm forecasting out each of the revenue lines in the most granular level for Alibaba. And if you guys don't have access to this model, you can get access to this model and all the other models that the Patreons get access to at the lower tier of the Patreons. So you can see that I'm forecasting total China commerce to decline by 2.6%. Now, in yellow, I've highlighted all the areas that I've made changes to. So China commerce retail, now I'm saying that it's going to decline by 3% in fiscal year 2023. China commerce wholesale, I'm growing out at 10%. And then thereafter, I'm growing both at 7.5%. For international commerce retail, I'm just going to grow that at 0% this year. And international commerce wholesale, I'm going to grow at 7.5% this year. And then 7.5% thereafter. For local consumer services, this I did forecast as a decline, but now I just brought it to 10% for the year. And I'm going to grow it out thereafter. And that's largely it. And so you're noticing that my total revenue is pretty much in line with last year, whereas before I was forecasting a decline. Going forward, I believe overall revenue growth remains at around 8% after fiscal year 2023. So this additional revenue that I'm forecasting will absolutely bring up the valuation for Alibaba. But before I go into the valuation, I just want to show you the adjusted EBITDA calculation as well. I've significantly increased profitability, but overall it remains in line with historical. So you can see that my profitability is around 19% going up to 21%. And you can see historically the profitability was as low as 18.5% and as high as 27.4%. And you know, there's previous years, but I'm just showing you the last 3 years because those are, I believe, are the most relevant. So in other words, what I'm telling you guys here is now I have enough information to be less pessimistic on the overall profitability of the organization. Now here's what my valuation comes up at. The share price valuation is approximately $222. So it's gone up by I think around $10 per share, but I do believe that the terminal multiple is low. Now I left it low just to show you where the valuation would be if I just took up revenue, but I do believe that I should increase the multiple as well. And so I think a 17.5 times multiple is better because they're still growing revenue and their profitability is getting better. And if you reflect that, you have a valuation of approximately $240 per share. But since the share price is so low as it is, I'm going to leave the share price valuation at $222 per share, which of course means that the current share price reflects 37 or 38% of the current share price. Now remember, in that valuation is approximately $40 of excess capital per share. So there's lots of cash to buy back shares. So just keep that in mind as you think about your valuation going forward. So that was that insanely thorough review of Alibaba's results. Now, if you guys missed that Alibaba Investor Day, which is what I keep talking about in this video, I actually made a 10-part video series on their Investor Day series last year, and I'll link to that video series right here.